Okay, have you ever fallen for the absolute ultimate trap in finance? Because I'll tell you, it's a trap that catches even seasoned investors totally off guard. It's assuming that a highly profitable company actually has, any real money in the bank. Because the hard, undeniable truth of the business world is simply this: profit does not always mean cash. Just picture this for a second. A company comes out and proudly reports $100 billion in profit. Incredible, right? But did they actually make any real money? Today, we're putting on our professional financial analyst hats. We're going to act like forensic investigators to figure out whether massive reported profits are a tangible reality or, well, just a clever accounting alibi used to mask some serious underlying trouble.
Welcome to This Explainer, the forensic analyst uncovering reality with the cash flow statement. My mission today is to help you uncover the real financial health of a business. And we're going to do that by learning how to use the ultimate lie detector in the financial world, the cash flow statement. Here's our investigation docket for today. First, we've got the profit illusion. Second, anatomy of cash flow. Third, the analyst toolkit. Fourth, spotting financial red flags. And finally, AI and financial truth. Let's dive right in.
Okay, part one, the profit illusion. Let's look at why reported earnings are sometimes just the alibi. As professional analysts, we know the income statement doesn't tell the whole story, not even close. So let's establish exactly what we're looking at here. The cash flow statement, or CFS, is a core financial statement that tracks the actual inflow and outflow of cash during a specific period. It answers one fundamental, incredibly important question: where did the cash come from and where did it go? If you look at the CFA Level 1 curriculum, understanding this document is an absolute necessity. It's the crucial third pillar of financial statement analysis. And honestly, this brilliantly illustrates why we need it. Over on the left, you've got the income statement. Sure, it shows profitability on paper, but it includes non-cash items like depreciation and uncollected credit sales. Then on the right, you have the cash flow statement. This is the cold, hard, undeniable reality of cash movement. Under standard accounting rules, a company can record massive revenue without actually receiving a single cent in cash from their customers yet. That right there is exactly why cash quality matters so much more to a professional analyst than just reported accounting profits. Moving on to part two, anatomy of cash flow. These are the three vital signs of any business. To truly understand a company's health, we have to break down the structure of this statement. Think of this table as our ultimate analyst dashboard. The cash flow statement is divided into three major sections. First up, CFO, or cash flow from operating activities. This is the cash generated from core business operations. A positive number here, that's exactly what we want to see. Second is CFI, investing activities. Now notice the good sign column for this one. You'd probably think negative means bad, right? Actually, no. A negative CFI is totally normal and often a great sign. Growing companies invest heavily in long-term assets like machinery and land, which naturally uses up cash today for growth tomorrow. Finally, CFF, financing activities. This is funding cash, taking out loans, paying dividends, issuing shares. Whether a positive or negative CFF is good entirely depends on the company's current strategy and life cycle. Section 3. The Analyst Toolkit. Let's look at the indirect method of uncovering the truth. So let's open up the toolkit and look at the most common practical approach analysts use to dig out these numbers. In practice, financial analysts almost always use what's called the indirect method. It's basically a massive reconciliation process. Step 1, we start with the net income from the income statement. Step 2, we add back non-cash charges, like depreciation. Remember, depreciation reduces the profit on paper, but nobody actually wrote a check for it. No cash left the building. Step 3, we adjust for changes in working capital. So the ultimate formula is CFO equals net income plus non-cash charges plus or minus working capital adjustments. Let's see how this pieces together with a quick mini case study for company XYZ. Imagine their income statement reports a net profit of 50 lakhs. As analysts, we step in to verify that. We add back 10 lakhs in depreciation. Then we notice accounts receivable increased by 15 lakhs, meaning they made sales but haven't collected the cash yet, so we have to subtract that 15 lakhs. But we also see inventory decrease by 5 lakhs, meaning they successfully sold off stock, so we add that 5 lakhs back. Do the math with me. 50 plus 10 minus 15 plus 5. The actual operating cash flow remains exactly 50 lakhs. It perfectly matched profit this time, but we had to do the forensic work to actually prove it. All right, section 4, spotting financial red flags. This is where we find the holes in the story. Now let's go into full detective mode and evaluate the quality of earnings using a real-world titan as our example, Apple. If Apple reports a net income of $100 billion, but their operating cash flow is a staggering $120 billion, wow, that is an incredibly strong sign. They're generating more actual cash than accounting profit. But what if their operating cash flow is only $40 billion instead? That would be a massive red flag, warning sirens everywhere. It would scream to us that they might have terrible collections from customers, or worse, they're using highly aggressive revenue recognition just to look good on paper.
So, the crucial point here is knowing exactly what warning signs to look out for. These are the classic traps heavily tested in the CFA exams and used every single day by the pros. CFO being less than net income, that's your first warning sign. A persistent negative CFO, major red flag. Seeing rising profits alongside a falling CFO indicates a massive disconnect. And if a company is repeatedly borrowing money, so showing positive financing cash flow, just to pay dividends to shareholders, they are literally surviving on debt, not their actual operations. Never, ever confuse paper profit with hard cash.
To filter out all the noise and really see what's going on, analysts rely on an absolutely essential ratio: free cash flow, or FCF. It is simply your operating cash flow minus capital expenditure. This number evaluates the reality of a company's financial flexibility, their true dividend capacity, and their ability to fund future growth. Basically, it's the real money left over after keeping the lights on and maintaining the equipment, completely ready to reward investors or expand the empire.
Section 5. AI and Financial Truth. Supercharging the modern analyst. Today, this forensic investigation has totally evolved. We're bringing artificial intelligence into the fold to make us faster and sharper. Tools like Microsoft Copilot allow us to quickly compare 5 whole years of cash flow statements in just a matter of seconds. It's a real game changer. AI can instantly identify abnormal trends, like that dangerous divergence of a falling CFO versus rising profits we just talked about. It rapidly calculates free cash flow and complex ratios. But, and listen closely to this, AI supports the analysis. It absolutely does not replace human judgment. As a professional, your conceptual understanding of why cash matters is what makes the AI's output actually valuable. And that brings us to our core takeaway for today, a concept vital for literally any investor to grasp and a heavily tested principle for analysts. The income statement, that shows performance. The balance sheet, that shows position. But the cash flow statement, that shows reality. You have to link all three together to see the complete, unvarnished picture of a business. Because at the end of the day, when the accounting dust settles and all those fancy adjustments are made, the ultimate truth in finance remains forever undefeated: cash is king. So I'll leave you with this final provocative thought. Let's say your favorite company just reported record profits. That's awesome. But have you checked their cash flow yet? Take this forensic mindset, look past the surface of the income statement, and go find the real financial truth in your own investments.
Welcome to today's Explainer. Look, if you're putting together your CFA Level 1 study plan, or honestly, if you just want to seriously sharpen your financial analysis skills, you're in exactly the right place. Today, we're building a structured study guide that separates theoretical accounting from cold, hard cash reality. We are going to master the cash flow statement. I absolutely love this topic because it's the ultimate truth teller in finance. It cuts through all the noise and shows you exactly what a company is really doing with its money. So where did the cash come from and where did it go? This right here is the fundamental question that frames everything we're going to talk about today. Every single financial analyst literally must be able to answer this question with absolute confidence. I mean, you can look at revenue projections and profit margins all day long, but if you can't track the actual cash moving in and out the doors, you're flying blind. This question is your anchor. Okay, so what exactly is this document? The cash flow statement, or CFS, provides a detailed account of a company's actual cash movement during a specific period. Think of it as our ultimate reality check for a company's financial health. It completely strips away all those non-cash accounting adjustments and just shows you the pure, unfiltered movement of liquidity. If a business is a living organism, the cash flow statement is tracking its pulse. Here's our game plan for today. First, we'll tackle operating activities. Second, investing activities. Third, financing activities. And finally, we'll pull the whole shebang together by analyzing the quality of earnings. Let's get right into it. Starting off with Section 1, Operating Activities, or CFO, the core business engine. All right, let's dive into this first section. From a CFA perspective, this is widely regarded as the absolute most important section of the entire statement. CFO essentially measures how much cash a business actively produces from its primary, everyday work.
We're talking about the cash actually received from customers and the cash actually paid out for the day-to-day running of the business. That includes payments to suppliers for inventory, covering salaries for employees, settling up taxes, and making interest payments. This isn't about what the company hopes to make, right? It's the cash currently changing hands to keep the lights on and the products moving. Now, as an analyst, you're constantly looking for signals. A positive CFO is exactly what you want to see. It's a sign of real financial strength because it proves the core business model actually works and generates cash. But watch out for the red flag scenario. A persistent negative CFO is an immediate, glaring warning sign. And notice the word persistent there. If a company is constantly burning more cash on its daily operations than it brings in from its customers, well, the core business engine is sputtering. Moving right along to Section 2, Investing Activities, or CFI, Allocating for Future Growth.
Let's see how this builds. While CFO is all about today, CFI is all about allocating for future growth. This section shows us exactly how much capital the company is sinking into its own future expansion, or conversely, if it's selling off pieces of itself. The key components here include the purchase or sale of machinery, heavy equipment, real estate like land, and various financial investments. So when a company decides to build a massive new factory to meet future demand, the cash spent to build that factory shows up right here in the investing activities section. And this brilliantly illustrates one of the most counterintuitive yet fascinating concepts in financial analysis. A negative CFI can actually be interpreted as a positive sign of expansion. Because a company has to spend cash to buy those big long-term assets, it's perfectly normal for growing companies to have a negative cash flow from investing activities. They're heavily buying assets to expand their footprint. So a negative number here isn't automatically a bad thing. In fact, it often means the company is betting big on its own future.
Next up, Section 3, Financing Activities, or CFF, Raising and Returning Capital.
Transitioning now to our final operational pillar. If CFO is the engine and CFI is the investment in a bigger engine, CFF tracks how a company handles the external funding for all of this. CFF focuses on how a company interacts with its capital providers, so its lenders and its shareholders. It shows exactly how a business pulls in new money or returns it. This includes cash coming in from borrowing loans or issuing new shares of stock. It also includes cash flowing out to repay that debt, execute share buybacks, or pay dividends to reward shareholders. This section tells you exactly whose money is funding the enterprise at any given moment. Now, what's really interesting here is how we interpret the health of CFF. Unlike CFO, where positive is almost always good, a healthy CFF depends entirely on the company's specific circumstances and strategy. Taking on debt to build a highly profitable facility might be great, but look at the red flag scenario. If an analyst sees a strongly positive CFF, meaning lots of cash coming in from loans or stock issuance, but it's sitting right alongside weak operations and a negative CFO, watch out. It may indicate the business is merely surviving through borrowing rather than its own profitability. They're surviving on borrowed time, not a sustainable business model.
Finally, Section 4, Synthesis, Quality of Earnings, the ultimate reality check. We've covered the 3 pillars. Now let's pull it all together and evaluate the overall quality of earnings. If you're going to screenshot any part of the study guide, this is the one to grab. It perfectly summarizes everything we've built so far. We have CFO, which is your core business cash. Ideally, we absolutely want to see a strong positive sign here. Next, we have CFI, your investment cash. Because we want companies to grow and acquire assets, this ideal sign is actually often negative. Finally, CFF, your funding cash. The ideal sign here completely depends on the strategic life cycle of the company, whether they're raising capital to grow or paying down debt and returning cash to shareholders. Locking this breakdown into your memory is absolutely crucial for quick, accurate financial analysis.
I want to leave you with this final, provocative question. Are you evaluating the actual quality of earnings or just the accounting profit? Understanding these 3 sections of the cash flow statement empowers you to see completely past basic accounting theory. It allows you to take a neat, tidy accounting profit on an income statement and compare it to the gritty, actual cash reality of the business. That is the true hallmark of a great analyst. Keep practicing these concepts, keep digging into those financial statements, and always, always keep asking where the cash is really coming from.
Welcome to The Explainer. Okay, today we are unraveling one of the most deceptive traps in the entire financial world. Imagine looking at a company on paper. Their sales are just through the roof. The profit margins look absolutely incredible. Everyone's celebrating, the champagne is popping, and then, suddenly, the company files for bankruptcy. Wait, how does that happen? How can a business that looks so incredibly successful on paper completely collapse in reality? Well, that is exactly what we call the profit paradox.
So this brings us to the central question we're answering today. How on earth can a company show a massive profit but still have cash problems? I mean, it seems completely counterintuitive, right? If you're profitable, shouldn't your bank account be overflowing? Well, the truth is that in financial accounting, profit and cash are fundamentally different measures. And to break down this ultimate business trap, we're going to use a really simple analogy today. We're going to treat a business exactly like a car out on the open highway.
Section 1. A car without fuel.
Picture this. You're in a state-of-the-art sports car, just flying down the highway at 100 miles an hour. The wind is in your hair, the engine sounds fantastic, you are making incredible time. And then, out of nowhere, the engine sputters, coughs, and completely dies. You coast to a stop on the side of the road. Why? Because speed isn't fuel, and profit isn't cash. See, just because your car is moving fast doesn't mean you actually have the gas required to keep it running. In the business world, your profit is your speed. It tells you how well the company is performing conceptually. But cash is the physical fuel in the tank. You can literally be the most profitable company in the world, driving at top speed, but if you run out of cash, your engine dies. Period.
Section 2. Dashboard versus gas tank. Let's look at the clear split here between performance and reality. On side A, the income statement is your dashboard. This is where you look to see your profitability. It's your speedometer. And you know, it feels amazing to see high numbers there. But on side B, we have the cash flow statement. This is your gas gauge. This shows the actual ground-level reality of your fuel. The core of our paradox today is that business owners get completely mesmerized by the speedometer on that income statement, and they just completely forget to check the gas gauge on the cash flow statement.
Section 3. Where did the fuel go?
So, if we're driving so fast, why is the car suddenly running on empty? Where exactly is all the fuel going? Well, our sources highlight 3 primary ways a profitable company actually drains its cash. We have credit sales, inventory tie-ups, and high debt obligations. These are the specific, under-the-hood mechanical failures that can drain the gas right out of your tank, even while your speedometer says you are doing great. Let's pop the hood and look at each of these.
First up, accounts receivable, which comes directly from credit sales. According to the rules of financial accounting, revenue is often recorded the very moment a sale is made, regardless of whether the customer has actually handed over the money yet. So imagine you just sold a huge batch of products. Your speedometer shoots up. Your profit looks amazing. But your customers didn't pay you in cash. They paid you in IOUs. In our car analogy, people essentially gave you IOUs instead of actual gas for your tank. Your profit exists entirely on paper, but your actual cash, it remains dangerously low.
Then we've got inventory tie-ups. When a company spends cash to buy inventory, that cash literally flows right out the door. But here's the trick. That expense does not fully impact your dashboard profit until that inventory is actually sold. You are spending your precious cash right now, but your speedometer doesn't reflect the drop at all. It's literally like spending all your travel money filling your trunk with heavy spare tires and parts instead of, actually putting gas in the tank. It drains your resources today, and it leaves you stranded. And the third major drain, high debt obligations. A company might be incredibly profitable in its day-to-day operations, but if they are carrying a massive amount of debt, they might be forced to use basically all of their available cash just to pay down the principal or the interest. It leaves almost nothing for daily operations. Imagine having to stop every 10 miles to siphon off your own gas just to hand it to a mechanic you owe money to. You won't get very far, no matter how fast your car is technically capable of going. Section 4. Glitches in the dashboard.
Sometimes the problem isn't just a gas leak. Sometimes the dashboard itself is straight up lying to you. Imagine a hypothetical reported income of $100 billion. If you look at the income statement of a company reporting this, they look like an absolute rocket ship. $100 billion in profit, the speedometer is maxed out. You think this company is completely invincible. But then you check the reality, the cash flow statement, and you see this. $40 billion in operating cash. Wait a second. You claimed you made $100 billion, but you only generated $40 billion in actual physical cash from your operations? That is a massive $60 billion gap between the dashboard and the gas tank.
When net income is significantly higher than operating cash flow, analysts see a massive red flag for weak cash quality.
It's called aggressive revenue recognition, and it essentially means the company is finding creative, entirely legal ways to record profit on the income statement before the actual cash ever materializes. The dashboard is glitching. You are quite simply not going as fast as you think you are, and blindly trusting that speedometer could lead you straight off a cliff.
Now, I should probably mention the reverse scenario real quick. Non-cash expenses, like depreciation. This reduces your reported profit on the dashboard, making it look like you're going slower, but it doesn't actually drain any cash from your tank. But our sources make it crystal clear that inverse relationship, where profit is super high but cash is low, that is usually the far more dangerous scenario for actual business survival.
Section 5. Keeping the tank full.
So how do financial experts actually run diagnostics on this stuff? Well, according to the CFA Level 1 perspective from our sources, the single most important indicator of a healthy company is a positive and strong CFO, operating cash flow. This is the actual vital gas going into the tank purely from your normal day-to-day driving. Are the things you sell generating actual cash? If your CFO is strong, your core engine is running beautifully and producing its own forward momentum.
On the flip side, there's CFF, cash flow from financing activities. This is cash that comes from borrowing money from a bank or issuing new stock. Now, raising money isn't inherently bad at all. But if a company is relying on financing activities just to survive because its operations, its CFO, aren't generating enough cash, that is a huge, flashing red light of financial instability. It means you are essentially hitchhiking or taking out a payday loan just to buy gas to keep your car moving. Eventually, you're going to run out of people willing to lend you gas money, and that car is going to break down.
And that brings us to the absolute core truth of this entire explainer, beautifully summarized by this quote from our sources. Income statement shows performance, but cash flow statement shows reality. Cash is king. Listen, it doesn't matter how fast you think you're going if your tank is empty. So the real question is, which of those seemingly invincible rocket ship companies in your very own investment portfolio might actually be running on fumes right now?
Welcome, trainee analysts. Let's jump right in. I am absolutely thrilled to have you here for this explainer. Today, we're going to build your diagnostic framework for uncovering corporate cash realities and, more importantly, spotting manipulated paper profits. As analysts, you're going to see a lot of shiny financial reports crossing your desks. Our goal today is to give you the X-ray vision you need to see right through that accounting magic and find the cold, hard cash.
Here's our roadmap for today's training module. We'll start with the paper profit illusion, then move through Step 1, mind the gap, Step 2, trend divergences, Step 3, mechanics of manipulation, Step 4, desperation and debt, and we'll wrap it all up with the analyst's golden rule.
All right, let's dive right into Part 1, the paper profit illusion. Time to uncover the truth.
So, picture this. A company reports massive blockbuster earnings. Say a major retailer announcing their absolute best holiday quarter ever. Your very first question as a trainee must always be, does that money actually exist in the bank? I mean, it sounds kind of silly, right? If they made a profit, surely they have the cash. Well, not quite. In the world of corporate accounting, profits and cash are often wildly different. What's really fascinating here is the stark difference between easily manipulated paper profits on the income statement and the unshakable cash reality of a business. Net income can be, well, legally massaged with estimates, non-cash charges, and timing tricks. Cash, on the other hand, cash cannot be faked. It's either sitting in the vault or it isn't.
To find that rock-solid reality, we're going to use your absolute new best friend, cash flow from operating activities, or CFO for short. CFO is the actual cash generated strictly by a company's core business operations. It completely strips away all the accounting noise and tells you, quite simply, if the business model is actually generating hard currency from selling its products or services. Okay, moving on to Step 1 of your diagnostic guide, minding the gap. Let's look at the macro view.
As an analyst, you don't just look at numbers randomly. We're going to follow a highly structured, 4-step investigative journey. Check the gap, analyze the trend, dig into the mechanics, and spot desperation moves.
Let's start with checking the gap. Imagine a telecom giant reporting $100 billion in net income, but they're only generating $40 billion in operating cash flow. Whoa. That massive discrepancy? That's your first major warning sign, and it demands immediate attention.
A gap this large illustrates what we call weak cash quality. Now, sure, some differences are totally normal. Think standard non-cash items like depreciation. But when the gap is this enormous, it usually means weak cash quality is hiding behind aggressive accounting magic. It means those record profits are largely existing on paper, not in reality.
All right, step 2, spotting trend divergences. We need to track the trajectory.
If you spot a trend where accounting profits are soaring, management's cheering, the press releases are absolutely glowing, but the CFO is steadily dropping, alarm bells should be ringing. Imagine a SaaS company reporting record revenue growth by booking multi-year contracts up front, but their actual monthly cash collections are falling off a cliff. That trajectory is fundamentally broken.
And what if that CFO is persistently negative quarter after quarter, year after year? That is an immediate blaring red flag. It literally shows the core business is not self-sustaining. It consistently fails to generate positive cash from what it actually does. Look, no matter what the income statement says, a business that is constantly bleeding cash from its core operations simply cannot survive indefinitely.
Which brings us to step 3, the mechanics of manipulation. Let's pop the hood and see exactly how they do it.
The primary trap here is aggressive revenue recognition. This is when a company books sales way too early, like channel stuffing inventory to distributors before they've even agreed to buy it. It aggressively inflates the income statement, making them look fantastic, but because no cash actually changed hands yet, there is literally zero corresponding increase in CFO.
And this directly inflates our next vital metric, accounts receivable. When a company pulls this revenue stunt, it leads to a massive spike in accounts receivable. Huge volumes of sales are being made on credit where the actual cash hasn't been collected, effectively starving the company of liquidity while they book those paper wins.
So the crucial takeaway for you here is this. When sales spike on the income statement but the CFO just isn't moving with it, the company is facing some very real liquidity issues. They might look highly profitable on the surface, but if they can't actually collect cash from those massive credit sales, they won't be able to pay their own bills.
That leads us right into step 4, desperation and debt, the final warning.
When core operations just aren't paying the bills, when that CFO is weak or negative, companies run out of options to keep the lights on. They're forced to rely on financing activities, or CFF, literally just to stay afloat. They stop generating cash from their customers and start desperately pulling it from lenders and the markets.
If you see a business taking out loans just to fund daily operations like making payroll or keeping the factory running, yikes, that's a massive red flag. But even worse, borrowing money just to pay out dividends to shareholders. It creates this illusion of a healthy, rewarding company, all while quietly burying the actual business in desperate, unsustainable debt.
Let's bring this all together with the analyst's golden rule for evaluating earnings quality.
Look, anyone can read a headline about record profits, but your job is different. By checking that macro gap between income and cash flow, analyzing the trajectories over time, digging into mechanics like aggressive revenue recognition, and spotting that desperation debt, you are successfully evaluating the true quality of those earnings. You are separating fact from fiction.
I want you to write this down and memorize it. Always remember this golden rule. A strong company typically shows a CFO that is greater than net income. Real, high-quality profits are always backed by real cash. When CFO consistently exceeds net income, it proves the business is a true cash-generating engine, providing actual, undeniable confidence to investors.
Now that you've got the diagnostic tools to see right past the illusion of paper profits, I want to leave you with this thought. How will you investigate the next blockbuster earnings report that crosses your desk? When the market is cheering for a record-breaking net income, will you just blindly follow the crowd, or will you look at the operating cash flow and uncover the absolute truth? Stay sharp, keep learning, and I'll see you in the next one.